Hey, what's up, guys? Welcome to a new video for my little show, the Market Pace. I hop on here on YouTube when I see some major changes going on in the stock market, and I do see some coming up right now. Then they are actually bullish, so it's kind of a nice time. As you can see behind me, I have the I Love Green for St. Patrick's Day, and I do see some green coming in the future for the stock market. So before I get into why I see that, let's just get this thing out of the way so I can maybe get this video out a little faster. Uh, Not trying to cover any sort of financial advice. The what I do in these videos is just what I see in the stock market, my opinion of that, and what I'm doing as a result of that. Not meant to serve as any sort of financial advice. I do always encourage people to go see financial planners and financial advisors to get a good foundation of where you are at and what you should be doing income-wise with your income, your goals, to get an idea of what type of investing and how you should be investing. And then with that foundation, you can then start to build upon that and improve your results and improve your, retirement and financial planning as you go on and learn. And you can probably learn some things from these videos, but true financial advice really takes into account your personal life, and obviously I know nothing about that, so these videos are not meant for anyone watching them in particular. They are just meant to show what I see in the markets, my opinion of those things, and what I'm doing. So that said, let's get into what I see. Um, Here we go with the chart of the S&P 500, and the biggest thing is that Dow Theory is back. Dow Theory is my favorite theory I've ever learned in the stock market since my time starting in this profession. With Dow Theory, that was something written by Charles Dow in a series of editorials. He did dozens of these editorials in the Wall Street Journal, and since then, many people have tested out his theory, his thesis, and typically it tests around 90% of the time as successful. So when you see this, about 90% of the time, you can expect to have prices continue going higher. And the things that led up to Dow Theory triggering, which was literally happened just yesterday at the close on March 15th, was that $1.9 trillion of stimulus happened. In case you lived under a rock and didn't hear that yet, that happened. So that's a huge stimulus for the economy. Also, as another technical indicator, the last point of resistance we had was this last high point on the 16th of February, and we just broke right through that as we triggered Dow Theory. So we have a bunch of stimulus, we have Dow Theory going, and we just broke through a major resistance. All these things do spell that, a bullish prediction for the stock market, for the S&P 500. And and also before I go into the next thing, we have plenty of states and just the country overall reopening, as well as vaccines rolling out at a breakneck speeds and increasingly breakneck speeds. So things are looking like they should continue going up, and profits should continue going higher and higher. So to capitalize on this, I'm going to get into a leverage position, which is the SPXL. This gives you a 3 times return of the performance of the S&P 500. So when the S&P 500 goes up 1%, you'll see this go up 3%. So I'm in this. Now let me go back to the S&P 500. Even though I will be in that ETF, I'm going to base all my decisions on the S&P 500. There's a little less noise, so it's a little more true to what's actually going on. I mentioned that the last point of resistance was up here, and we broke through that. So typically when old resistance is broken, it becomes new support. I'm going to make the support just a little bit lower, around 39.10 roughly, and honestly, just to make it a flat number, let's just do 3900. So let's put that down there. So how I'm managing this trade is if it drops under 3900, which is a little less than 2% from where I had started this at the close of March 15th, then I would close the position, and I would take between a 5 and 6% loss on that SPXL. But I am expecting this to go up more like 10% or maybe even more if conditions keep going the way they are. It could Like, for instance, when Trump had taken the presidency a few years back, the Dow Theory triggered then as well, and it was going all year long, and that was a 20 to 30% gain in the S&P 500. When the leverage position, that could have been 60 to 75, much much nicer. But you have to just hold the position until the things that got you in it break, which would be the Dow Theory. So I'm waiting for either the transports to drop or maybe the S&P 500 to drop, either past that point of support or maybe 5% if it gets a higher. And of course, you got the transports. They at their high point here, March 15th as well. If they drop 5% somewhere, then I would also get out of any leverage position because the Dow Theory just isn't there anymore. It's not present. All right, so yeah, very bullish. Of course, though, no trade is without its dangers. So here we have the TLT ETF, which shows bonds. Bonds are a major thing to watch right now. They've just been dropping off the face of the planet the last kind of month or two, as all the stimulus has been happening. The value of these bonds just isn't there. I guess no one wants to really trust the U.S. Treasury bond when the Treasury is just doling out money left and right. And to pay for that money that's getting doled out, they need to issue more bonds, which is more selling pressure, which just adds to that no one wants to buy these to begin with, and the government wants to sell a ton more. This is going to put a big pressure on the bond market. If these continue dropping, then interest rates will go up, and if interest rates go up, then the cost of debt goes up. Many of the most growth stocks in the S&P 500 are typically grown and funded through debt. Great example of this is Netflix. They have so much debt that they take on basically every time they put out an original series. It's funded through a loan that they either get through the public markets or through a bank. And as interest rates rise, they're going to have to pay more interest on those loans in order to offer a competitive bond that people will buy. So it makes it more expensive to grow, which makes their profits go down. It makes them harder to make more profits and harder to grow their profits. And that's all bad things for their valuation, which is all bad things for the stock market's valuation. So major thing to watch here. The thing I think is going to happen though with the bond market to save the bull market in stocks like the S&P 500 is that the Fed comes and talks tomorrow, the 17th, about any new changes they're going to have to fiscal policy on their side. Now, the Federal Reserve's already buying a ton of bonds as it is, both private bonds from companies as well as these treasury notes, but they can always step it up because they have that unlimited bank account. Now, if they do, that will kind of reverse this large drop going on here and will make the bond market more or less healthy, which will be great for the stock market. The other thing to watch, and I've talked about this in my last video. I was saying that after the dollar bumps up over 91, we could see some turbulence in the stock market. And around February, that did happen. It happened again here. And we saw a little bit of turbulence. It never got too bad, though. The S&P 500. The S&P 500 never dropped over 5% from its highs. So anything less than 5%, I kind of just consider more or less normal fluctuations, especially during the volatile times that we're in right now with all this inflation and such, and all the stimulus bills, and the virus, of course. So it never dropped, the S&P 500 never dropped under 5%. So there was no major cause for any major concern, and I never made any major changes. I just stayed in a non-leveraged position in the SPY throughout that time. But we are seeing a little bit of a danger here as well. So what's going on technical analysis wise here is back in July and August, the dollar was dropping from inflation that was spurred by all the COVID stimulus, but it found some support here at 92, and then it dropped under this as a result of the second stimulus. Yes, as a result of the second stimulus. Yep, that's it. Got my dates mixed up for a second. So it dropped under this from the second stimulus. Inflation was happening. Market was doing really strong. And now we're getting some turbulence around this $91 mark. And we're retesting the last support, which when support gets broken, it then typically becomes resistance. And we're testing that resistance right now. So if we see a good bull market happening in the stock market, we're going to see this dollar bounce off this resistance line and start heading back down. That's what we want to see. If it does pop up above this, then we might be in for some chop. Now, there's only one, I guess, one narrative I can see happening that would cause the dollar to rise, especially as we just had $1.9 trillion of stimulus entering the economy, which should drop the dollar since it's all new money. What's going on in Europe right now is a couple of nations are still struggling with the virus, aren't exactly reopening. In fact, some of them are even going back into closings. And they actually just took off AstraZeneca's vaccine. They thought there was some side effects from that they didn't like, so they had taken it away. And that's one less vaccine to help speed up their recovery and speed up making the virus less of a big deal. If the closings over there can start to pick up, though, that would mean their next move would be stimulus, which will drop the euro currency as well as the pound and a couple other foreign currencies. And when foreign currencies drop, the US dollar rises, typically. So that is the danger I see going on with the dollar. If Europe and other countries don't have as good of a reopening as we do or are, the future will tell. If they don't, they may have to stimulate their economies even more, which means more foreign dollars going into the market, which will drop their currency value. But in return, ours rises, which may cause some trouble in our stock market, and it will kind of make the inflation trade that is pushing all these prices up in property values, stock values, gold values, everything. That would kind of stop that. It would put a wrench in those gears there. That's about it. So yeah, overall, I think the market is pretty safe. The Dow, so I'm in a leverage position because Dow Theory is typically not wrong, and we're in a nice risk versus reward type of position. But I am watching the dollar, and I'm watching the bond market. I'm really hoping the Federal Reserve kind of comes to the rescue yet again and does anything and everything they can to support the recovery, and they will step in to buy bonds, especially as the government needs to sell $1.9 trillion worth of bonds to fund this new stimulus bill.